So what's going on with the big banks like Barclays and Morgan Stanley, and not the Mike Wilson bear? We already know he's a bear over at Morgan Stanley. What are the primary researchers at the institution suggesting? Well, here's the latest from Barclays, and then we'll get into Morgan Stanley. They have different looks at the current economy, but take a look at this. FOMO, folks. FOMO. FOMO has seen frustrated bears turning into reluctant bulls. You know, this reminds me of just a week or so ago, we covered a T.S. Lombard piece where T.S. Lombard said, look, we're bears, but we're buying because stocks are going up. And I thought that was rich. I'm like, wait, what? You're positioning into stocks even though you're bearish because stocks are going up and you're afraid they're going to go up even more? Like, if I said that on YouTube, I'd get chastised. Like, I already get chastised if I just say what I'm going to do and I'm fully transparent about it. But to say, I'm a bear, but I'm going to go long, blows my mind if people will say that. But that's true. That's what's been happening. And so Barclays is picking up on this. And so they're talking about position normalizing and risk basically spreading out throughout stocks within the U.S. economy, especially to some extent in the U.S., mostly in the U.S., whereas in the EU and the U.K., you still have a lot more defensive positioning. So what does that mean? Well, let's look into this. Most investor types have bought equities over the last month. Mutual fund equity inflows were the highest level in June since February, as private money moved to neutralize some of their long-standing underweight. So in other words, you've got this, remember the Bank of America survey where we had somewhere around, a 32% underweight from fund managers for equities? Well, you're starting to get that flip-flop. That's finally starting to happen. And here you see low volatility has allowed certain systemic strategies to continue re-risking and hedge fund betas to equities nudge up. Okay, in English, basically, hey, look, volatility is so low, you can still buy your bearish puts, but just go long equities as well. And that's somewhat what we're starting to see happen on top of this AI frenzy, bringing in retail investors. And listen to this, who had stayed on the sidelines for most of the year. Depressing. It always seems like that's how folks miss some of the best returns of the market, is by waiting for like a royal invitation to get back in. Getting back in is the hard part. You either get in too early or you get into it late. It's very difficult to be perfect on out perfectly and in perfectly. Anyway, amongst all this, we note short equity future positions have been trimmed, adding to the sense of degrossing / going back up towards benchmark equity weight. In other words, balancing out, going back to, all right, we got to have stocks at a normal position in our portfolio. All right, what else do we have about cash here? Hold on one second. Sorry, I've still got this nagging cough and cold, but don't worry, it's not going to stop that beautiful, sexy lecture release this weekend or that price going up tomorrow night for all the programs on building your wealth, whether it's the 0 to Millionaire real estate investing, the stocks and psychology of money, or the income, how to make more money and get SH9T done faster course featuring AI. Really good lectures, by the way. A lot of good compliments coming out of that one. So what do we have here? Despite the latest buying spree in equity, overall positioning is balanced at best. See, a lot of folks, and I see this regularly, anytime you have this crash in a market, and then you have a little bit of a recovery, the first thing the bears do is say, oh, it's just a bear market rally. Like, this is just the beginning before we leg down again. The problem is, that's how they end up having an excuse to stay on the sidelines. Well, the issue then is when we continue to actually go up, their excuse starts weighing down, and you start going, all right, so like, how are you going to position now? Well, apparently, most new money is still going into cash and bonds. Listen to this. X-asset flows, which basically means, where's the money going, are mostly new money, is mostly being directed to the bond market and money market. So let that sink in for a moment. If somebody comes upon new money, so, they sell a house, let's say, and they've got 200 grand, from equity from selling their home, where is most of that money? Well, more than 50% of it is still going into cash via bonds or money markets. This is a way of suggesting that you're nowhere close to the days of Tina where everybody's like, throw everything you have into the stock market and you got the euphoria of November of 2021. You're nowhere close to that because of positioning today, which is actually bullish. That's fantastic. Anywho, positive EPS revisions have provided fundamental support to equity inflows, but stand in contrast to mixed economic or activity data. Therefore, the upcoming earnings season may be make it or break it for stocks. We've talked about this as well, that you would expect some pre-positioning going into this Q2 earnings season. And I think that's why we've seen some volatility over the last few days, where we've had quite a few red days. And by quite a few red days, I mean like 4. And because of not only some end of the quarter rebalancing, but also hedging going into earnings. All right, fine. What else? Tech is driving regional equity flows. All right, well, we kind of knew that. That's U.S. investors, however, are starting to sell their European equities for the first time this year. Now, this I found interesting. I've been saying, probably for just, quite frankly, a few years now, get me out of emerging markets. I don't want emerging markets. I don't want the S&P 500. I want tech, chips, and innovation. I don't care about the rest of the world going through this crisis. I think the U.S. is going to weather it the best. And you're finally actually getting rotation from U.S. investors dumping their foreign crap and getting more properly positioned in U.S. stocks. Good. And that's probably because Europe is feared to actually go into the recession or a recession, whereas the U.S. may dodge it. Outflows from UK stocks continue unabated amid renewed stagflation worries. Yeah, especially with that spike in inflation over there. Japan continues to see strong inflows. I'm not sure why, but anywho. Tech inflows masked uneven sector trend, positioning on banks cut sharply. Global flows have been going predominantly into tech, but active manager performance in Europe have taken a hit as value/cyclicals have fared better in Europe. So in other words, for Europe, value stocks. America, tech, baby. Tech exposure has quickly moved to above average for hedge funds. That's true, but not yet for your typical investment advisors. Keep in mind, that's different from a hedge fund. A hedge fund, pretty much anybody can make a hedge fund. You don't have to be licensed to create a hedge fund. Hedge fund is just sort of like, yo, I got fun. Accredited investors, give me your money and I'll trade with it. That's basically a hedge fund. That's different from like an ETF where you position into specific stocks with a specific predetermined strategy that's transparent. And it's different from a financial advisor actually sitting down with somebody personally and giving them financial advice. I've never done that. Even though I'm a licensed financial advisor, I got my license for my ETF. But anyway, so what else do we have here? Lower equity volatility may persist through the summer. Fine. All right. Boring. Some of this is somewhat insightful, though. Okay. Frustrated bears have become reluctant bulls. Over the last month, mutual funds resumed buying equities for the first time since February. Now, that's a big deal. Mutual funds buying. That's great. A lot of the folks with money, they still put money in the mutual funds. I don't know why. I don't know why you put your money into a mutual fund instead of an ETF. I literally cannot find a single reason why you would do that. But people still do. And the fees are a lot higher. Anyway, the tax benefits aren't as great. Talk to a CPA. Anyway, the bigger year-to-date picture is unchanged, with most flows going to safe assets, and the flows to equities may prove fleeting. And they always say that. Anyway, last week, equity flows turned negative again on hawkish central bank talk and weak data. But it's noteworthy that equities were being bought despite the negative economic data. Yep, that is a style of going risk on. All right, great. What else? So here's the bull bear index, mostly positive now since the start of 2022, or the most positive since the start of 22. You can see here at the end of 2021, you really got this big decline, and that really started moving up again at the beginning of 2023. Fantastic. Okay, so we've got Morgan Stanley to look at in just a moment as well, but I like looking at this here. High frequency data like retail call option buying has moved up sharply to the highest level in more than a year. I generally prefer buying shares just because, remember, with timing the market, when you're doing options, you're really timing it 2 times, if not 3 times, because you're timing the buy, and then you're determining how long to hold, and then you're determining close, and then do you roll the option or do you go to shares? There's a lot that could go wrong. Whereas if you just buy shares and the stock goes up, boy, it's a lot less stressful. And you know, selling calls in a Nike swoosh environment is risky. Although some people look and go, hey, you know, made good money this year so far, why not? Fair, fine. But then again, you know, the crazy thing is, the year has almost perfectly aligned with when we started seeing the Nike swoosh. I don't know that anybody really expected that. I know we expected the tax loss harvesting in December and then rebuying in Jan. But the fact that we pretty much Nike swoosh starting Jan 1, pretty wild. So of course you're going to have outsized gains year to date for 2023, but most people didn't buy all their junk, you know, in the first trading day of January. Anywho, so what do we have here? Option volumes high, demand picking up again, great. Rising optimism on stocks amongst retail. Okay. Cash bonds remain king. Yep, talked about that already. All right, so we're going to go over to Morgan Stanley. We'd like to take a look at Morgan Stanley. So, Morgan Stanley. Oh, Morgan. What have you to say? So, Morgan Stanley, this was a little wild. Ready for this? New work on the labor market now supports a soft landing. You know, I'm trying to find bearish pieces, but even the bears are starting to sound bullish. Kind of interesting. So, what do you got over here? You got, we see wage growth slowing into 2024, but identify 5 key factors that should keep the unemployment rate low, underpinning our call for a soft landing. All right? Let's get into the 5 factors in detail. So, hard landings or recession. Our call for a soft landing is underpinned by a market, a labor market, that slows but remains resilient as companies in certain sectors continue to backfill positions as well as retain existing workers. Now, this is interesting. So consider this idea of a backfilling. And what Morgan Stanley is going to do is they're going to evaluate, as well as what other institutions have been doing, is they're evaluating this idea that a lot of people have at their jobs potentially been overworked since the pandemic, just because it's been so hard to get your hands on this actual proper amount of labor. And so what they've done, companies done in general, is if they just overwork their existing workers, and backfilling is a way of saying, okay, let's take some of that stress off and start pulling back a little bit to where we're saying, all right, let's distribute this evenly. And that type of backfilling supports continued hiring. So that way you're not putting as much stress on your existing workers anymore. There's actually another piece by UniCredit. UniCredit right here is a piece, we broke this down. This was just from a couple days ago here. But take a look at this segment right here. There are many factors that could explain the slow response of the labor market to the Fed's tightening cycle. Well, we know we've gone up 500 basis points, so why is the labor market doing so well? First, the full effect of a monetary policy change on output is usually transmitted with a lag. We know that unemployment tends to be lagging. So, in other words, that we're still gaining significantly into what we've gone to a pretty tight or restrictive macro environment led by the Fed. Second, unusually high savings stock built up during the pandemic has allowed households to keep spending. Now, we've heard this before. People have more money, with the exception of those in the lower, maybe 40% of incomes. They've already spent their money. But those higher levels are continuing to spend, and that's supporting earnings growth at companies. Or even if it's not earnings growth, at least it's supporting earnings flatness. But that earnings flatness is allowing companies to retain their talent. Third, still high profitability of firms. Right. Well, that combines with spending, right? You need revenue, and the profitability is margin. You're not having to squeeze margins so low yet that you're saying, look, just to survive, we need to start laying people off. You haven't gotten to that point yet. I really think some of the layoffs that we've seen at big tech have been what I call opportunistic layoffs. Opportunistic layoffs are kind of where you're like, dude, we've gotten bloated. We've hired too many people. Half of these people don't even show up for work. They're not productive. They don't care. They're just collecting a paycheck. If we fire them, we're going to get sued. But if we lay them off because of an economic recession, then they won't sue us. I honestly think a lot of that goes on. Anyway, and then finally, the service sector, which is driving the phase of the recovery, is a sector that favors a shift from spending goods, obviously to services, whatever, is still expanding. And so you've got these 5 elements that are why you're seeing this labor hoarding. And I thought this piece was perfect to combine with the Morgan Stanley piece right here. Wait for that right here to load. There we go. Because that's what they're talking about, this labor hoarding. And now Morgan Stanley phrases this slightly differently. They suggest that the economy is still understaffed. And this is what that backfilling means, where you're saying, look, we're still overworking people, and we get another person in, now we can get into a little bit more of labor balance at our companies. And really, a lot of companies don't want to lay off the good workers just for the sake of a little bit of a margin boost, because when the economy starts booming again, it's going to be hard to find those people again. So it'd be better to get through the tough time with less revenue, or maybe flat net income or whatever, but at least get through with great people who are going to do fantastic work going into the next cycle. So that was fascinating from Morgan Stanley as well as UniCredit. So that's a little bit on hiring. But what else do we have here? When it comes to productivity, Morgan Stanley made this interesting argument about GDP, looking at GDP data per worker. And that's how they were identifying that people are still being overworked, and that maybe by hiring more, you're actually just bringing this into a balance. And that's why you're potentially continuing to see this hiring. What else? We also note this here. Past cycles indicate that state and local jobs tend to recover more slowly than private sector employment, mainly due to revenue shortfalls causing budget pressures and the inability to keep up with private wages. So really, it's a way of saying that when the economy starts booming, the private sector gets all the jobs because the government doesn't have as much money to pay competitive prices. And in a few recessions, local government workers actually end up losing jobs because even local governments get squeezed. But that's more like your 1981 and 2008 recessions. Knock on wood, you don't see that today. That would be bad when you start seeing that public sector laying off people. However, as the private sector slows down and they finish their backfilling, now the government can actually step in and start hiring people because there's less competition for people. So this is kind of wild. I hadn't heard this argument before, but take a moment here and think about that for a moment. One second. I'm so sorry. This cough is just absolutely killing me. But every time I take like a brief little pause, just think that when I'm coughing, I'm going, coupon code expires tomorrow. All right. So I hadn't thought about this before, but I think it's such an interesting perspective that, okay, so private sector hiring goes down, and then you kind of go low, and then it's almost like you hit like a clown bell. Ding! Oh, now governments can hire. Government hiring goes up. And so the overall level of hiring actually stays elevated. That's actually kind of incredible. That's fascinating. All right, let's keep going here. So let's see. Okay, that's the labor hoarding segment. What else do we have here? Morgan Stanley suggests that they do not see unemployment getting close to 6%. They don't see it. They think that unemployment may increase slightly, but nothing close to the levels of 6%. The prediction of 6% assumes the post-COVID relationship between postings and unemployment seen from 2020 to April 2022 remains valid. We argue that the shape or position of the curves that they refer to, may change over time and point to the fact that recent data prints seem to be moving along a different path. Now, they use these fancy charts here, like the Beaver Ridge curve, which on one side plots the vacancy rate, on the other side plots the unemployment rate. And the idea is that usually the lower the vacancy rate, the higher the unemployment percentage. But as is usually a problem with history, is that every cycle has elements that are different. And so now they're charting a soft landing. They're like, wait a minute, we have a higher vacancy and a lower unemployment rate. This is interesting. So, things slightly different than you would have otherwise expected. In addition to that, they expect higher labor force participation will come out, and we'll continue to see labor force participation actually grow over the next few months. Now, there were some banks that I don't have a full piece on from them, but there were some banks talking about how they expect unemployment claims and the jobs creation level to finally actually start showing negative reads starting in about September, October, which is actually coming up. We're already basically in July, which is crazy. That means we're already done with half of the year. That's pretty remarkable. But anywho, so here is also an exercise where they come to this conclusion and say, in a more recent example, a positive 100 basis point shock to wages only raises inflation by 10 basis points. Now, this was another shocker to me because history tells us that a wage price spiral occurs when wages rise, prices rise. But this cycle, I don't like to use the phrase this time is different, but this cycle has so far been different in that this hasn't so far really been a wage-driven inflation. It was a money printing and supply chain driven inflation disaster. And so now you've got Morgan Stanley estimating that even if we see wages rise by 1%, we actually expect inflation to only go up 1/10 of that. That's insane. 10 basis points. So in other words, to get a full percent of inflation, you would have to see wages go up 10%. That's insane. They call this the fall in the inflationary pass-through, representing a substantial reduction in the dynamic effect of wages, which is something that history would be like, no. But the recent data is showing exactly that. Look at this. Wages explain only minimal fraction of price movement in recent years. You can see that here in the orange. This is how much wages are really contributing to inflation relative to the blue, which is how much wages used to contribute to inflation between the 70s and 1999. That's remarkable. So, how do we piece this together? Well, you have Barclays talking about bears becoming bulls because they're FOMOing, yet positioning still mostly cash and bonds. Are you kidding? And then Morgan Stanley's like, yo, this employment situation ain't that bad. And UniCredit, both of them are like, dude, even if private sector hiring goes down, the government step in, it'll be their turn. So you got buffers. The unemployment rate probably won't go as much up as much as people fear. And wages aren't actually driving inflation. This is remarkable. Like, I want bad news because I want to challenge my opinions. I met with, who remembers when I did the interview with Gordon Johnson? Ay. This sucks, man. Anyway, I did the interview with Gordon Johnson, and he's a Tesla bear. And one of the reasons I wanted to do that, and you should look it up, just type into YouTube, meet Kevin Gordon Johnson. It's really good. But one of the reasons I like putting myself in front of the bears is because I truly want to hear their argument. And I'm like, give me the best you got. Like, make a good presentation. Convince me to sell, is what I say. And I just haven't been convinced. So that's not saying I'm going to be right. But, obviously inflation could somehow magically skyrocket again, I guess, in America. It happened in England, which, in the United Kingdom has. But, I don't know, short of that, it just doesn't seem that horrible.
Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by